Welcome back to the Williams Real Estate Channel. Today we are discussing the key traps that will catch a lot of people off guard in 2026. So buyers beware before you get caught up in all the fuss. I'll save you from losing your shirt. As you know, if you've been following us for some time, we use the 18-year land cycle framework as it plays out to give us guardrails to work out when to buy, when to stop buying, which a lot of people tend to have trouble with. They get the FOMO, classic euphoria FOMO towards the tail end of booms. So it gives us the guardrails to say when's no longer a good idea to keep buying in a certain market, when to even strategically renovate. As the market picks up, you'll have equity. You can draw that equity out to then reinvest it into your portfolio to make improvements, renovations, additions, and even developments. You may wish to do some developments as the market starts to run, and having this framework and knowledge of the framework is so powerful to not only capitalize on the upside, but to also protect the downside and be ready for when the market turns and not overextend yourself in certain periods like we are today. We're on the blue marker, coming now into an equivalent point of time, early 2007 in the prior cycle. So from here, we'll run through some charts where I see high risk, and I wouldn't be buying. I wouldn't be putting my own personal money there. I wouldn't be suggesting for clients to definitely not buy in these regions. Both metro and region will run through because at some point, sure, there might be another year or so of sugar hit, but you'll end up buying peak market and holding an asset for many years with next to no growth, and if not even in negative equity. So from here, let's visualize from 2007 and onwards in all these future charts to give you a guide of where these markets could be heading into the future. So this is one of our 5 key fundamentals to buying any property. So I'm getting a lot of people hitting me up saying, oh, do you only just buy because of this? No, it's one of 5 main factors. Number one factor, buy real estate for at least half, if not a third of its intrinsic value. Number 2, strong yields between 6 to 8%. Number 3 is the 18-year land cycle. Number 4 is in a region with a growing population and public investment, so large metro markets and large regional hubs. Number 5, in a suburb that will experience gentrification in time. So there are key fundamentals, and we only buy if they all stars align. But this is a key framework we operate within to invest. First off at the bat is Townsville. If you want to lose money, if you want to lose your shirt, go buy up in Townsville. And it's quite amusing as we'll go through these slides. Buyers agents are pushing people into the likes of these markets, and it's classic of where we are in the cycle. In the pre-GFC, we had a big mortgage broker boom. When the market turns, took most of them out, and they went back to doing the job that they had prior to the mortgage broker boom. Same goes for stockbroker booms. We saw that pre-GFC and in the 80s and in the 1920s. We had insurance broker booms in the 90s and in the 2000s. This whole buyer's agent boom is just another brokerage boom. They're all going to get, I see 80, 90% of them getting taken out when the market turns because they're pushing people into markets like this. Townsville. As you can see, Townsville has been going off like a rocket. This is houses in one of the suburbs, troughed out at 200 grand, medium price point now hitting over 500. So it's more than doubled. And if we look back at similar points of history, between 2000 and 2008, went off like a rocket. come 2008, switched off and went backwards for over a decade. So we are here, equivalent point of time. Sure, it's going booming, but when you buy property, you buy the future growth. You don't buy what has been historically. So a lot of people rush in saying, "Oh, let's buy Townsville," and you know, get pushed into markets by buyers agents saying, "Look, it's been booming, let's get in." But you're not buying this growth. That's already baked in. You're buying what happens into the future. And typically markets don't go on more than 150% growth from trough to peak. They top out, the local wage can't keep pushing it forward. They then go through long stagnant flat periods or even downturns like the likes of Northern Queensland that have the dependency on the mining sector, and take many years to trough out before wages rise, yields become attractive, prices then follow. How I see a lot of people getting caught out now in Townsville specifically is because the yields still look attractive, 6, 7%. However, if you look at long-term trends, when the mines slow down, the jobs dry up, the big high-paying jobs evaporate, people can't afford high-paying rents. The yields also get cut in half when the rents soften 40, 50%. That then counteracts the market price and down she goes. So here we are, booming, but as you can see from 2007 and 8, there's a couple, probably a year or so for it to run, and then at some point we'll hit a limit, switch off, and then go backwards for many years. So if you bought now in Townsville, at some point in the next decade, you could end up in negative equity. And if you want to build a long-term sustainable portfolio, that's not how you do it, because if you go buy property and then you're in negative equity, you won't be able to get your cash out of it. You'll be in mortgage prison. You won't be able to offload it because you'll be selling it at a loss. You can't draw equity. You'll be stuck holding it. And then if it goes vacant, then that's the danger zone. So buyers beware. Townsville, by far number one on the list not to buy in 2026. Number two, Gladstone. I picked out we could pick all the towns up the north coast of Queensland, but these are the bad ones. So Gladstone, as you can see, has been going off like a rocket from 18, 19, was sub 200, now hitting over 450, nearly 500. So again, more than doubled. And as you can see back in history, continued to go strong up until 2012, 13, then hard downturn after the mines slowed down. So this time round, who knows whether it will keep going for the next couple of years. It's dependent on the mining sector, but at some point it could well land in negative downturn. So again, this is a chart that you don't want to be investing into. Boom bust town. If you want to go and you know, have a bit of a punt, you can might as well just go play some roulette at the casino. For a seasoned investor, I mean, when the market comes around again, I'll be buying up in these types of towns as a short-term play, buy and trough, sell at peak market, but not something you want to hold long-term because it's unsustainable. Sunshine Coast. So we're going further down the coast of Queensland. From the north part is higher risk, and then as we keep coming closer towards Brisbane, there's more diversified economies, not solely dependent on the mining sector. So the markets don't go through hard downturns. If a market isn't solely or predominantly reliant on the mining sector, they don't go through really downturns. They just plateau out and flatline. So as you can see, Sunshine Coast houses had a solid run from 15, 16 up to date. Went from 700 grand to over 1.456 million. So it's more than doubled. If we look back at history, it might have a little bit more to go, but then more or less will flatten out and even go a little bit negative, trough out before then picking up and running again. So there's a good 10 years where I can see this particular suburb in Sunshine Coast flatlining for a good decade, where we won't see it go from 1.5 million to 3 million for a good 12, 13 years' time. Strathpine, just north of Brisbane, another Classic example, buyers agents pushing people into these markets that have no real idea. They've built their massive portfolios off the back of their business, but when it comes to actually property investing, I don't believe they have what it takes. It's all glitz and glamour and marketing. So that's fine until the market turns, we'll end up taking most of them out. So as you can see, Strathpine, solid run, 18, 19 up to date, went from sub 400 to 900, more than doubled. We look back at history, similar boom up to 2007-8. So we'll continue to go strong from here, but within the next year or so, we'll top out, soften, and flatline for a good decade, just like what happened from 2008 to 18. So you're buying the future growth. People remember, if you're going to go buy $1 million house in Strathpine, you can probably be sure that's going to take you a good decade before you'll go through another growth cycle. So you buy it today for 800-900 million bucks, hold it. You might get another 5, 10, 15% growth, 20%. Then you'll lose 5, 10% by the time the market turns into 28, 29, and then you'll be holding it at that price point for a good 10 years. So I see more or less reaching its limits, Strathpine. So again, a trap for 2026 and onwards. Pimpama, Queensland. So this is just north of the Gold Coast. Again, as you can see, solid run from 2020 to date. Went from sub 500 to over a million, so it's more than doubled. And if we look back at similar points of history, 2007 and onwards, had a little bit more to go, but then eventually topped out and then went through a pretty subdued, flat, negative growth path. So again, another market I don't suggest putting your money into. You pretty much be buying peak market and end up holding it for many years, if not even in negative equity once it softens out. Surfers Paradise, Goldie. So this is units I've got for Surfers Paradise. At some point, it's starting to look like it is hitting its limits as it's starting to roll over. But had its solid run from 2020 to date, went from 400k medium to over 800. And if we look back at similar points of history, 2007, 8, had a little bit more growth and then topped out and then went through a downturn. So I can see Surfers Paradise Gold Coast apartments getting smashed in the coming years. I mean, we've already seen Trump. He's going to be building Australia's tallest building up there as well on the Gold Coast. Hey, mate, how'd you go? We've got a deal, mate. Get him to buy that other one that you've got for, 360. Sweet. All right, mate. Awesome, mate. I'll update it now and get him to sign it off and get done. Cheers, mate. Bye. Sorry, agent just called. Another deal done, but not in Surfers Paradise, I can be sure. As you can see, had a solid run, topped out. It's topping out now, and more supplies coming on. So Harry Triggerboff is having a field day. He's building like crazy, and now we've got Trump. He's going to start throwing up buildings too. So we see toward the tail end of the boom, projects become feasible for developers. They have to go higher than ever. Trump has to build Australia's tallest building in Australia to make it stack up. That creates the oversupply scenario towards the tail end of the boom downturn. Classic property cycle. So for developers, it's key to get across this stuff because it gives you a framework to work out where the market's heading, because you might start a build, but it could take you 2 or 3 years to finish it by the time it goes through council and build. You want to know where the market's heading based off long-term trends and overlaying it with the cycle, because that's how developers can get wiped out, is when they bank on a certain price point, like now in Surfers Paradise, 800 plus median price point, but then it could well soften to losing 20, 30%, just like what happened from 2008, which we're coming into, hit 400, then went down to just above 300. So lost a good 30, 40%. 30%. If a feasibility on a project was done for 800, by the time they build it and release it to the market, it could only be worth 600. And then that's what can send developers bust. For Harry Triguboff, he just holds, rents them out, keeps them long term. So he doesn't rely on a bank. He hasn't relied on banks since the 70s, hence why he's the biggest in the game. After the downturn in the 70s, the land-driven downturn in the 70s, that's when he vowed to never use banks again because Citibank was trying to sell him up and he was playing off ANZ and Citibank to get him through the couple of years out of the rut. So buyers beware. Sunshine, surface paradise, you'll be buying peak market and you'll end up in negative equity in the coming years. Bunbury, so this is over WA, south of Perth. As you can see, off like a rocket. Houses went from just over 400 to now over 800, more than doubled. If you look back at history, it kept going strong, 2007-8. So this could be it. At some point, it'll start to roll over, and then it'll be all downturn for a good 12 years. So best assured to steer away from regional WA at this point of the cycle. Margaret River, same story, absolutely charging off like a rocket. And if we look back at history, 2007, 8, had a little bit more, but then topped out and then went up and down, pretty well subdued and flat for a good 12 years. Shepparton. So this is an interesting one. I know other buyers agents are pumping people into Shepparton to keep ahead of their high volume, buying supposed bread and butter properties. Sure, you can buy affordable houses, cheap houses out Shepparton, but you'd be buying peak market. As you can see, it's had its solid run from 250 2018 to over 500. It's doubled. And if we look back at history, 2007 and onwards, it topped out 250 and then pretty much went next to nowhere for a good decade before picking up and running again. So there's no rush. Cheap today can mean cheap tomorrow. Timing's key. So there's definitely no rush. And the yields aren't even great. So what's the point? Put your money in the bank and get 5%. There's no point if taking on the risk, next to no growth. So definitely not a market we're suggesting to buy. We keep tabs on it, obviously, once it comes good. I like to enter markets once I see a good 7, 8 years of stagnant growth. So once it stagnates out for a good 7, 8 years and we track it with history, and that's when we want to enter after 7 to 8, 9, 10 years of stagnant growth, when it's any time, and mostly it's the time where the sentiment is at its lowest and the deals are the best. Adelaide, again, has been booming recent years, but if we look back at history, continued to go strong from 2007, 8, and then more or less topped out and flatlined for a good decade. So again, Adelaide houses, don't bother. And same goes for Tassie. Buyers agents are already starting to get down to Tassie. They're getting in there a bit early because, as you can see, Tasmania houses had a solid run in the second quarter from 16 to 21, 22, topped out, went through its downturn, showing signs of stabilizing, and will pretty much flatline from here, just like what happened from 2007, 8 to 16. Good 10 years for it to do not much at all. So there's definitely no rush down in Tassie. As always, this is by no means financial advice. This content is general in nature. Get independent financial, tax, legal advice before making any investment decision. But if you want help buying an investment grade property and being guided through the turbulent times ahead, it's not all sunshine and rainbows. At some point, the lights will come on, the party will be over, and a lot of people will be left with big hangovers for many years. But if you're ready and you've got your ducks lined up, get on the right side, get in the right market, ride the next wave, because when the market does turn, the regions that I've just showed you, that's where all the demand's heading into now. When the mines slow down, the jobs dry up, people will be flocking back to the likes of Sydney, Melbourne. Sydney, Melbourne will be away at the races again, just like what happened from 2007, 8 and onwards. So timing's key. price point's key, asset class is key, because there's not one type of asset, region, area. If it's metro, regional, if it's residential, commercial property, if it's equities markets, there's not one asset or region that consistently outperforms as the cycle plays out. Every asset class and region has its time in the sun. And we use the 18-year land cycle to give us clarity to firstly work out where we are in equivalent points of time based and looking at history, long-term trends, and then allocating funds and riding the next wave and being contrarian investors, going against the grain. So until next time, thanks for watching.